close. Here's a mortgage rate forecast for the next 5 years. And listen up, because things might not be heading in the way you think they are. First and foremost, mortgage rates are not based on what the Federal Reserve does. Instead, they track very closely the yield on a 10-year Treasury. So to understand where mortgage rates are going, what we need to do is understand where bond yields are going. And if you look at this forecast, they're not really going anywhere. Forecast comes from consulting firm Deloitte, by the way. But on top of bond yields, you also need to take into account something called the mortgage spread. This is basically a premium that investors earn for lending to mortgage holders instead of the US government. And during normal times, this is roughly 1.8 to 2%, meaning that if spreads stay the same, mortgage rates are going to hover between 5.9 and 6.1%. A lot higher than most people are expecting, and that's with normal spreads. Current spreads are closer to 2.2%, meaning that if spreads stay the same and this forecast is right, mortgage rates might not go below 6.3%, which is why I keep telling people not to count on rates going down. They might, but it is far from a sure thing. Here's a mortgage rate for